evening. Welcome to the dwelling place. This is Evangelist Doris J. Roberson. I greet you in the name of our Lord and Savior Jesus Christ. We are so excited tonight to be welcoming those that are joining right now from Facebook as well as YouTube, and especially our first time viewers. We want to say welcome, welcome, welcome. Before we go any further, I want to offer a word of prayer. Dear Heavenly Father, we just thank you once again for this opportunity to share valuable information. And we just thank you for our guests on tonight. We just honor you, Lord, and we just give all the praise, the glory, and honor to you for what you have done through us and will do through this broadcast on tonight. Bless each and every one. Bless our presenter on tonight. We certainly give you all the praise, the glory, and honor. In Jesus' name, we do pray. I want to set the stage on tonight. All month long, we have been celebrating Women History Month. And with that in mind, we are recognizing the contribution that women have made to our American history. And tonight, we are just grateful for this young woman that I will introduce shortly. But we have had some dynamite presenters all month long. We've been talking this series about passing it on. How important is it to pass on valuable information, whether it be spiritual, whether it be personal or natural, your skills and abilities? And tonight, that's what we're focusing on. Our subject matter for tonight is creating wealth and passing it on to generations and generations to come. Well, we're going to hear more about that. I want you right now to tag one other person. You got to tag somebody and let them know you need to know more about money, financial stability, planning for just retirement. This is a session you do not want to miss. I have with me and this beautiful young woman. I'm so excited to have Danielle Byrd Thompson. Danielle Byrd Thompson is a native of Michigan, but she is a blessed young lady who has attended Howard University, where she got her bachelor's degree in finance and went on to get her MBA in finance as well from the prestigious Howard University in DC. Well, she has a lot of credentials and she is equipped to talk about this subject matter. She is here on the screen. You can see her contact information. She's a partner of TPF Financial. Her contact information is there. But what else I want to share with you? She is the second African-American female that has entered into Equitable Hall of Fame. What an accomplishment. What a way to be recognized by a well-known financial institution. So with that in mind, I want to set the stage. I want our audience to know tonight this is about you, about answering your questions. So in the chat tonight, I want you to start putting your questions in. You got investment question, retirement question, saving and 401 questions, things of that nature. She works with business owners, nonprofit organization, and many different types of and one-on-one. So I want you to feel free to ask your questions. I'm going to go off the stage and come back, and when she invites me back, to monitor the questions in our chat. So those that are joining from Facebook and YouTube, you may have to give permission to StreamYard to participate in the dialogue. But certainly you can do that right in the chat. So I'm going to start this conversation and remove myself off the screen. I'm going to ask Danielle, what does generational wealth mean to us so that you can set the stage? What is generational wealth and what led you to get into this line of work? Why are you so passionate about it? Would you answer those questions? And then it's in your hands to continue to lay the foundation and inner dialogue with our audience. God bless you. Thank you for being here with me on tonight.
Thank you so much. Thank you. Thank you, Evangelist Roberson. I appreciate you having me here on your wonderful program that touches the lives of so many and allows so many to be blessed by your content. So thank you so much for having me. Here today, we are going to talk about generational wealth. What is it? How do you build it? How do you create it? If you have it, what do you do with it? As I start to get into that subject matter, I do want people to know that this is going to be very conversational. It will certainly be an open dialogue. I know sometimes that finances can really seem overwhelming and complicated. And what I found is when we don't know what to do, we don't do anything, right? And that's not always the right choice to make. So, with that being said, this is the best way to pose questions. People don't necessarily know who you are. So I want you to feel free to throw a question in the chat, raise your hand, flag our evangelist, and she will certainly address your questions. So just to kind of get started, what is generational wealth? Generational wealth can be pretty straightforward. It is passing assets forward for future generations, right? What are assets? Of course, assets are cash. Assets are investments. They're stocks, they're bonds, they're mutual funds. Assets are property. It's real estate. It can be a host of different things. But that is what generational wealth is that when we are planning not only for our lives, but we are planning for our future and the generations that come after us. And that is especially poignant if you have children, right? So that's kind of where we'll start. I'm going to start my segment today. And we're going to first start with how we create wealth. And that's done through a couple of key things like retirement savings, investment accounts, life insurance are a couple of ways that we can start to do that. But before I dig too deep in those subject matters, I want to invite Evangelist Roberson back to the stage just to kind of start to address any questions or concerns and things like that.
Okay. I don't see any questions at this time. So if you want to continue, but I do want you that are listening, feel free to put the questions. This young lady has a rich background, and she are already making me think about some questions that I personally might have in terms of passing it on. So let's just start with the easy questions about managing money and teaching our children about money concepts. And how do you do that? Tell us even how you got into this. Why are you so passionate about it, Danielle?
Thank you. So when I was at Howard University, my major was finance, and there was a real emphasis on corporate finance. But one of the things that I saw was there was not a huge emphasis on individual finances, right? Of course, corporations have the resources to hire tons of people to advise them on really what they should do with their money, how they should reinvest it, how they should invest it, what should be allocated to the firm for this, for growth and development. But one of the things I noticed, and especially in my community in Metro Detroit, was I didn't know any financial advisors. I didn't see people meeting with folks, kind of telling them, hey, have you thought about doing this with your money versus that? And so I saw a real need within my community to share that valuable information about how to help people grow and maintain assets and then how to turn assets into wealth. So that has always been my passion and my interest to help my community, those who I serve, really have a more viable and healthy financial life.
Very good. That is so good to know. We have a couple questions.
Sure.
How do you begin saving for generational wealth?
Great question. So let's start with some tools that we can use in our financial toolbox, right? First and foremost, everyone needs to have a bank account. To some people, this may sound obvious, but one of the things that I've noticed with this younger generation that comes up, they're not into our traditional banking methods. A lot of them are using online banking tools, which is fine, but sometimes tried and true can always be best, or they're using those preloaded cards, right? I want everyone to at least foundationally have a checking and savings account, right? Checking is for obviously what we are using to transact everyday expenses, but then we're building our savings account. Our savings account is exactly that. It is money that we are putting away for an emergency. Now, with the savings account, people always ask, how much money do I need in my savings account? When do I know? When do I hit the limit? Is that what should I have as a running balance, right? So, any financial advisor will tell you anywhere around about 6 months worth of living expenses, right? And so this is a goal that everyone wants to make number one on their financial list of goals and priorities if they don't. So, what does that look like, right? That looks like, let's say your monthly expenses are $2,000 a month. 2 times 6 is 12. So that's $12,000 that you need to have on hand in your bank account. Now, this is for my folks that are still working. This is not necessarily for retirees, and I'm going to circle back to retirees in a moment. But if you are working, right, reason they say 6 months worth of living expenses is because anything could happen. Life could happen. You could lose your job. You could be laid off. You could be in an accident. And so typically what analysts have found is 6 months really is the right amount of cushion that you need to have if you were unemployed and you needed to be working to find gainful employment. When you put those type of parameters in place, it allows you not to have to disrupt your financial plan. What I mean by disrupt your financial plan is if you have retirement investments, our goal is that even if you got laid off or you lost your job, you would not have to liquidate those assets, meaning spend them down to be able to get you through your bout of unemployment. So that's the first goal. Now, if you're retired and you're receiving a pension or Social Security, that's going to look a little different, right? Because you're not going to lose your job. You've already lost it in a good way. You are retired. You don't need to carry a high balance in your savings account. Typically, retirees need about 3 months worth of expenses in their savings account. And that number is lower for obvious reasons, right? They have a guaranteed income stream most of the times at this point that is not going to change. It is not, life events are going to impact them a little bit differently. Also, if they're retired, they do have access to their retirement accounts, like their IRAs, their 401ks, all that good stuff, right? And so at this point, they could access them without penalty. So again, if you are still in the workforce, recommendation is that you would have about 6 months worth of savings in a bank account, and then 3 months if you're retired. Once you've hit that number, you can pivot, right? So sometimes people say to me, whoo, I don't feel comfortable. I know my monthly expenses are $2,000 a month. And I know you're telling me that I should have $12,000 in my savings account. But if I don't see $20,000 in my savings account in my bank, that's going to make me very uneasy. Well, 6 months is still that right number, right? At that point, things are kind of working against you. You can be using your money in different ways to grow and appreciate for you than just sitting in a savings account. Okay.
Mm.
So, what does that look like? What things should you be doing outside of savings? Now, the first thing, and this is so, so important, is retirement savings. This is something I want you to do in tandem with saving in your bank account. So, if we use this same example of expenses are $2,000 a month, and you say to me, Danielle, $12,000, that's a lot of money to have in a savings account. I typically keep my savings around $1,000. Well, I'm going to give you two goals. I want you to set the goal to save 6 months worth of expenses in your savings account. And I still want you participating in your retirement plan with your employer, or if you're self-employed, on your own. Those two should always be happening together, right? So what does that mean? If you work for a company, you probably have a 401k. If you work for a local municipality, like a city or a state, you probably have something called a 457 deferred compensation plan. And if you work for a nonprofit, like a public school district, a hospital, a university, you probably have something called a 403b. Typically, when a retirement plan begins with the number 4, that is your employer sponsored plan, and they are different based on who your employer is. Most commonly, you will hear 401k referenced the most in the media because that is what most people have. Most people are working for corporations that are in the business of making a profit, right? Nonprofit and local municipalities, we don't hear that terminology as much, but I want to make sure that we are inclusive to those folks as well, because you can have any one of those based on who your employer is. The goal is still the same. You should be contributing, and you should be contributing at minimum at a rate of 10 to 15% of your income. Okay. So I don't know if we have questions or thoughts
Yes,
there.
you do. We
Okay.
do.
Okay. I will pause for
Okay.
that.
All right. Let me see here. I'm going to go back to, there's a question. How young should a child be when parents obtain life insurance policies for children, teenagers, given our violent world? That's one. Hold on to that. And there was a question about, let's see here. I know at least 3 people who have experienced student loan forgiveness. How would you advise them to do with the money they now have unencumbered?
Awesome. I understand. So I am going to get into life insurance. So for the person who asked a question about life insurance for children and young adults, I will address that when I circle into life insurance.
And there was also some questions about, do you continue to invest as a retiree? And when you are in your 60s, where would you start in where do we start in our 60s?
Okay. All great questions.
Okay.
So I'm going to begin with the last question in terms of where do we start in our 60s, right? So
Yes.
one, regardless of age, still need to have that 6 months worth of expenses, right? So everyone needs to make that a priority. And that is before anything else, with the exception of retirement savings. So retirement is going to be very significant for a lot of people, because we are in a world that is getting rid of pensions. That is what most generations, I'm a millennial, prior to mine, have been exposed to, which is a guaranteed monthly check. Also, a big factor to be aware of is that in 10 years, in 2034, Social Security is going to be cut by 20%, right? So a lot of people don't know that. We don't have a lot of conversation around that. Of course, as we get closer to that, we're 10 years away, we will see more conversation about that. But that is happening. So I want everyone to know, if you are in your 60s or in your 40s or in your 20s, retirement savings is so critical and so important. It is not too late if you are in your 60s to do that. What does that look like? What should you be saving if you're in that age? The max, right? The max is a big number. If you are over 50, the IRS allows for something called catch up. Not like the sauce that goes on your fries, but catch up. Okay. It is allowing those who are over 50 to invest more for retirement. That number this year is $30,500. It's a big number, but if we're getting started later, we got to take a big bite out of retirement investing.
So
If you're
Danielle, let me interrupt you. So 30,000, you can, and that doesn't work against those that are in the 60 realm.
It does not. It does not. Anyone who is over 50 can now save. If they have an employer-sponsored retirement plan, they can save that much into their retirement plans.
Okay. Okay. You clarified my thinking. Okay.
Yep. And so I would highly advise that. If you're under 50, the max is $23,000 a year. I would highly advise folks to max out if you can, right? Bite the bullet, get used to it, start off strong, and you have that money going in the background, coming off of your payroll check immediately. Because for people who are probably under 50, retirement is going to look a lot different than what it did for the generations before them, right? Social Security is pushing that age back further and further. And we see that people are working now well into their 70s. I meet with clients all the time who tell me, listen, I'm not planning to retire until 75 because I haven't been doing what I was supposed to. And so they understand that, but no, we've got to contribute more and we've got to be comfortable with working a little bit longer.
Okay. Very good. So, go ahead.
There was a question about student loans, right?
Yes.
What happens? What should people do now that they have had their student loans paid off and now that they have extra disposable income, per se, that was going to student loan payments? So the first question I will ask is, do you have 6 months worth of expenses in your bank account? If you don't, that would be the first thing to do. Okay. And with that, where are you with your retirement savings? If you cannot do that max of 23,000, you most certainly need to be saving 10 to 15% of your income for yourself. Does not matter what your match is. Sometimes people say, hey, my employer is matching 5%, so I'm putting in 5. I'm not doing more than the match. Why not? It's your future. 10 to 15% is the goal. If you can do more than that, I want you to highly consider max funding for retirement.
All right. Another question. Is there an allocated amount to put away? Is the amount based on your AN, and how much, unless that means age?
And so in terms of retirement, yes, there are rules and regulations. And so first, you can put in any percent you would like until you reach the max, right? The max is a flat dollar amount that's regulated by the IRS, and it is $30,500. If you are over 50, it is $23,000 a year annually if you are under 50.
So do you continue to invest as a retiree? And what about retirees?
Yeah. Absolutely. That's a great question. So thank you so much for that. And that brings me to my second point, right? So let's say you have your savings appropriately. If you're a retiree, you've got 3 months worth of savings. If you are still in the workforce, you have 6 months worth of savings. If you are still in the workforce, you are saving for retirement at 10 to 15%. And then the second thing that we can be doing to build generational wealth, regardless of, if you are in the workforce or if you are a retiree, is creating an investment account. What is an investment account? An investment account is our second step, right? And that only comes into play If you have the allocated amount in your savings account and you are saving into your retirement account if you are still working. If you're retired, you cannot save into a retirement account. But an investment account is where we want to put additional funds. An investment account is an after-tax financial instrument that holds stocks, bonds, mutual funds, fixed annuities, which are more comparable to CDs, ETFs. It can pretty much hold any financial tool that is on the market. This is something that has no parameters associated with it typically, meaning it is not a retirement account. You do not have to be a certain age before you withdraw money. There typically are no penalties associated with it based on your age and or your employment status. This is an account where you can invest at your risk level, right? And you can be conservative if you're a retiree that is comfortable taking little to no risk, typically as most retirees are, or if you are a 20 something or 30 something and have a long time horizon in terms of when you want to use the money, you can take whatever risk level you would like. And that is what I would recommend for those who have hit those two parameters that we've discussed before. That is a great way to have your money work for you instead of just having it sit in a bank after you've met that 6-month kind of minimum expenses. Now we want to start taking money and investing it in a manner that you are comfortable with for your own personal goals, right? It could say, hey, if I'm 25, I want to be a homeowner by the time I'm 30. That is the power of let me put $100 a month away, or let me save something that I am comfortable with to meet that goal. If you say, hey, I'm planning a big trip. I'm a grandmother and I want to take me and my grandkids to Kenya, right? I want to do that. That you can say, hey, my goal to do that is by the time the youngest grandchild is 10. An investment account can help you use the power of investment level returns to have your money work for you in a different way. So wherever you are in life, whatever spectrum you are on, this is another tool that you can use to help grow your assets in a different way, that don't typically have any restrictions associated with them as it relates to your age or anything like that, that you can leverage in a different manner. And so you could use that for whatever your goals are financially.
We have a couple more, and
Sure.
let me give you these couple questions. Can you talk about Medicare taxes once you hit 65? Also, another question is, at what age can you withdraw from your retirement account without penalty?
Great questions. So retirement accounts are a little different depending on who your employer is. But let's start with 401ks. And this is a parameter for every retirement account that's out there. 59 and a half. That is the magic age by the IRS, right? So at that point, working or not, you can pull money out. So if you are 62 and you are still working, you can take money out without penalty. If you are 60 and retired, you can take money out without penalty. If you are 58 and retired, you cannot take money out without penalty. You have to wait until age 59 and a half. Now, 403Bs work a little differently. Of course, 59 and a half is the magic age, but if you are 55 and retired and you have a 403B, you can take money out without penalty. If you are 55 and still working, you cannot take money out. And then for our 457 deferred compensation plans, that's plan there's no age requirement. So if you can retire from your state at age 52 and you have a deferred compensation plan, you can take money out of that plan.
And you want to talk about Medicare taxes once you hit 65.
So I am a financial advisor. I am not a tax specialist. So that would be a question that you would want to pose to a CPA about taxes at 65, specifically as it relates to Medicare.
Okay. And did you speak to the insurance piece? Buying, I know at least 3 people who have experienced student loan forgive. Oh, okay, we talked about that. But yeah, what age should parents buy insurance for children or teenagers? What is your recommendation?
Yeah, that's a great question. That's a great question. So, let me pause here. I will not have a conversation about life insurance for children unless the parents are insured. Okay. So,
All
step
righty, that's a
one
good one.
is we have to protect our own lives first. Yes, tragedy can speak, but most of the times our children will survive us. That is, the goal, of course, right? And so we need to make sure that first we are insured properly. So whoever asked this question is going to say she's going to take the long way around, and I am. So forgive me for that. So life insurance, let's talk about it, who it's appropriate for, when we should have it, all of those good things. There are many different types of life insurance. So typically, sometimes people think there's only 2. They think there's term and there's whole. And in communities of color, we most frequently say whole. It is really permanent insurance. And under permanent insurance, there's an umbrella of different types of insurance. Things like variable universal life, whole life insurance. There's index universal life. There are many different types of policies, right? But foundationally, the difference between the two, term and permanent insurance, is term is just that. It is for a term. It is 10, 20, 30-year term, and it covers you at that rate and at that price. So that is how that works. Typically with term insurance, it is a payout of $500,000, $1 million, 250, whatever the payout is, and that covers you for 20 to 30 years. After that term is over, the cost goes back up, right, to whatever current rates are. Permanent insurance is a little bit different. It covers you throughout your entire life, right? As long as you are paying that premium for that guaranteed amount of time. So, with that though, there typically is a cash value associated with that policy that allows you to borrow and have access to it earlier. Generally speaking, there are different recommendations in terms of when you should have life insurance. But it typically can be anywhere between 1 to 10 times your salary. That is really the expectation of people ask, how much life insurance, how much death benefit coverage should I have? So it's going to look somewhere in there. And life insurance really should be based on that number because you are your most valuable asset. It's not your house, right? It is not your car. It is not any of those things. It is your life, right? Your ability to work and to provide for your family. So that's when we think about 1 to 10 times your income. That is that number that we're talking about, right? So I want everybody to be aware and comfortable with that figure. So when should children have it, right? That can get a little convoluted because they don't have an income, right? And so that is mathematically a more difficult thing to determine. But if you have insurance and you have a plan for yourself and for your loved ones and your beneficiaries, then it is appropriate to start looking for life insurance for your child. And that can be done through, on the permanent side or on the term side. Term is typically a little bit more cost effective and budget friendly, but it can be a great tool to pass down to your child. So, they have already been insured if something, God forbid, were to happen to them and they had some pre-existing, health conditions or things like that and became uninsurable at a point, they would have those policies that you already secure for them. I think really, anywhere over the age of 5, you can get insurance. It really is a matter of preference. One, when is it financially feasible for you? Two, are there other things that you are doing for your child as it relates to saving for their education? And we'll get into those type of things too. But again, 5 is a good age, I think, to maybe start looking at it. Obviously, just like with life insurance for adults, the earlier you get it, the more cost effective it is. It is much more cost effective for a 20-year-old to get a life insurance policy than a 60-year-old. And that's just going to be for children as well. Again, because they're still so young, it's not going to be too big of a cost impact, but it's going to be much more cost effective for a 5-year-old to get some life insurance versus a 18-year-old. So
Danielle, I want to read these next 3 so you can kind of be
sure.
aware of the questions. We have a question: what can we do to start young children with the importance of savings? That's one. Which Would government bonds be a good investment after age 60? And then also, can term insurance be converted to whole life? And I can read them back to you. And I do want to interject for those that are on Thursday, we have an attorney who specializes in estate planning and wills. And so it kind of, she probably will be covering some of similar things as it relates to some estate planning.
Okay, so really great questions from the audience. I'm so glad that people are so engaged and are asking these really very solid questions. So first, when is it, how are we teaching kids about generational wealth? So
Yes.
I am a mother of 3 young children. And so this is something that is so important to me, right? Because we can do all these things for our kids, and we can create these retirement accounts and investment accounts, and we can have our savings right, and we can be well insured. But at the end of the day, if we are not teaching our children the principles of money, how to respect money, how to appreciate money, how to save money, how to be good stewards of money, then they certainly will not be true beneficiaries of what they are blessed with in the future. So, with that being said, 3, I think at 3 years old, that is the age to start exposing and teaching children to money. At that point, most of them can count, right? Maybe just to 10, but they have some appreciation for numbers. It is a great time, right, to gift a child a piggy bank and to explain to them what a piggy bank is. A fun thing that we do in our family and that we do when we gift kids things, we gift money, but we give them cash and just $10 in ones. And that's a great activity for kids to count money out. And we talk about how much we keep, how much we save, how much we share if you have siblings, and those type of things, right? And so that is a fundamental time to start to expose kids to how to save. Shortly after that, right, we can start talking about opening a savings account at a bank. What does that look like, right? And so It is building it into a routine and a practice for you and your kids. I think 5, 6 is a good age to conceptualize and understand, okay, this is the bank. We are going to go here once a month, once a week, and you are going to bring what is in your piggy bank, right? And we are going to make a deposit. The reason why, and I mentioned this, I had to have a preference at this point really for brick and mortar versus online banks, is because when you're teaching a child that they should be saving, it is a good idea for them to experience going to the building, walking in the building, showing them how to do a deposit slip, how to give their money to the teller, showing them a balance printout. That is what we want to start to expose our children to, so that they understand and respect money. And so often, when we go out, we cover things, we pay for things for our kids, but every once in a while, it's okay to pivot and ask your child, do you have any money for that? Can you pay for that cheeseburger that you want at this restaurant? Or can you buy this other little item at Target? Yeah, I have money. Yeah, let's talk about how much money do you have? And what are you willing to spend? Are you going to spend all your $10 on, this game at Target or Walmart? Then you have no money left. Are you okay with that? So that is kind of what we want to start to do. As our children get older, we want to look for things like junior achievement clubs and things that expose kids in middle school to investing, to stocks and bonds. A great way to do that. Let's not overcomplicate it. Let's look at what we use around the house. Let's look at the things that you like to do. You like Disney. You watch the Disney Channel. You have a Nintendo. They have stock, right? Let's just follow their stock price online, right? We're starting to expose them to that. These are things that you like to buy. Maybe you create a custodial investment account with that child and let them buy their first share of one of those things that they use every day.
Wow. Excellent information. I can see you going higher. And, what came to me was, I was thinking as a grandparent, let's say you have, want to be a blessing to your grandchildren, and say it's, let's say it's 2,000 per kid. And over a period of time, let's say 10 years later, this money has grown.
Absolutely.
Is that a good way to, not knowing whether or not, like, as you said, whether they're going to be good stewards or good beneficiaries of what you have put aside. And maybe they don't even know. And then say at the age of 18, now you've gifted them with this. What's your recommendation about that? Or can you put conditions on it?
That's a great question. So my thought process there is I love 529 plans, right? 529 plans are college savings plans for the child's future collegiate expense.
Somebody need to put that in the chat for me. I can't. Go ahead. Go. 529 plans.
529 plans. And this is the great thing about 529 plans. Anyone can open them for the child. So I have people said, hey, I want to be a blessing to my grandchild. I want to open something for them. Hi, I'm concerned. I want to help my grandchildren, but my son or my daughter is not the best steward of money. And so I want to make sure that this gift goes directly to them, right? What can I do? Well,
this is very good.
Oh, great. I'm glad. You can open a 529, grandparents, aunts, uncles, great aunts, uncles, cousins, anyone. All you need, it would be in your name. The beneficiary would be the child. All you need is the child's date of birth and the child's social security number, and that is open for them. We are putting money away for them for it to be used for college expenses only, right? So there's no access prior to that. and it goes in that investment account for them when they go away to school. Now, this is the other reason why I love 529s is I've had folks say, okay, that sounds really, really good, but this is my concern. My granddaughter is 12 and she loves to do hair. She might become a beautician and may not go directly to college. Or my grandson, he's into school, but he's really been talking about going to the service lately. What do I do if that happens? There is a new law that has changed the rules around 529s, and this is why I absolutely think this is a really good way to position the assets for the kids. Let's say you've been chugging along and you've been putting $25 a month away for this child and in this 529, and you have amassed $40,000 by the time this child is ready to go to college, right? And this child says, I'm not going to college, I'm going to the Navy. This 529 can now be converted to a Roth IRA for that child. That way, that money now is going to go to help propel them in their retirement. So you are still gifting them something. You are still creating a generational wealth and inheritance for that child in the future. And there is no penalty if that money is not used for college. So that can be a great tool to leverage and to do something powerful for that future generation.
So, Danielle, if the parent has transitioned, will they still be able to convert it?
That's a great question. That's a great question. So the child is the beneficiary of that account, right? And so let's say the grandparent or the owner of the account transitions prior to the child going to college. That account still cannot be used until that child goes to college. And if they do not go to college, then it still can be transformed into a Roth IRA for that. Now, I will say this, and your next guest on Thursday will probably speak to this. It will be important, right, for those who are saving for their children, grandchildren, any future generation, that in our wills, we always have a plan that dictates if I am no longer here and I have these assets and some of them are dictated to minors, right? This is the person who should take the financial ownership of these accounts if I pass away and the child is still a minor. Okay.
Awesome. Thank you so much. And I don't want you to forget the other two questions.
Can you ask me those questions again?
Yes. The question was, let me go here. I believe it was, can term insurance be converted to whole life? And would government bonds be a good investment after the age 60? And before you said, I hope parents are taking everything you said because it's educating them, because, many times people pass on assets and you find out later they have been just diminished because they didn't understand the value of what was given to them.
Oh my gosh. Yeah, I've seen that so many times in my practice. So again, great question about term and whole. Yes, term can be converted to whole life insurance, right? So this is sometimes how this would work in this potential scenario. Sometimes when we have, depending on budget constraints, and a lot of times I'll relate that to growing families, like when your family is young and you've got young kids and you're paying for this and that, right? You need to be insured properly, but maybe you cannot do that with a whole life policy, because the difference between term and whole, they're few, but foundationally that cost is what's significant. That monthly premium is different, right? So a lot of times we see young families get term. You've got a couple kids. Hey, I know if something happens to me, I need $500,000 worth of coverage. I got to get 2 kids through college. I got a house to pay off, et cetera, et cetera, et cetera, right? But as we're going through that term, we may realize, and this typically is how it works, as our kids are getting older and more independent, right? The financial demand on parents should be going down. In addition to that, our assets should be going up. Like our home, we're probably closer to having that paid off, now than we were 20 years ago. We probably have more in our retirement accounts now than 20 years ago. So the need for life insurance can diminish. Typically, you need more younger, and then as you get older, you need less, kind of like a wave. And so that can be a great time to convert to permanent, where you had a policy or whole life, as your guest said. If you had a term policy for 500,000, perhaps now you've owned it for 20 years, you've got 10 years left on the term. Hey, you say, I think I'm going to convert half of it, 250,
Okay.
or I'm going to convert 100K of it, because that is an appropriate need for me at this point. If I were to pass away, my loved ones would inherit my home. They would inherit, my vehicle, all of my assets, right? Which look much different and are much more robust now, after I've been working for 20, 30 years, than they were when I was 25 and I got the policy, right? So yes, you can convert it, and it can be based on your situation. It can really be a great thing to do.
Very good. And before you answer, I think there was a question about the bonds, government bonds, or
Yes.
something like that. I can go back and look at the question. There is a question: explain why start with a 529 rather than establishing a Roth account. And the other one was in reference to the government. Would government bonds be a good investment at the ages or after the age of 60?
So yes, it can be, for sure. It depends on what your risk tolerance is, how comfortable you are with the risk. It sounds like if you're interested in government bonds, they're very conservative, right? And so we know we're not going to see a lot of price volatility, a lot of movement, or anything like that. So it can be a very stable, secure investment. And sometimes in our 60s, that's what we're looking for. We're either in retirement or getting ready to retirement. So we're looking at vehicles that can really mitigate and lower risk. So that can certainly be an appropriate investment for those at that point.
Okay. And I want to throw out a question. I know you're going to answer the question as it related to explain why start with a 529 rather than a Roth. But recently in the home buying market, they're saying that more grandparents or families are helping their children purchase homes opposed to or maybe making it convenient for them to put their down payment opposed to renting. And so I want you to talk about that from a generational asset investment. If there are people that have the ability to help pass along or help family members or loved ones, sons, daughters, nieces, nephews, whatever the case may be, is that a wise way? And should there be any strings attached? So that's a question.
So just to kind of start there. So, one, I want people to understand it is wonderful to be able to help. And I've had folks say to me, Danielle, I want to pass something to my son now while I'm alive and I can do it. I don't want to wait until I pass away. And, who knows when that will be. And I see him kind of struggling now and I want to help now versus later. Got it. But I want you to understand you have to have the financial resources available to do that. That doesn't necessarily, because you have the cash on hand and being financially able to do that are two different things, right?
Okay.
So what does that look like, right? You need to make sure that everything looks good in terms of your monthly expenses and your monthly income, especially if you're in retirement, what you have set aside for your future. But most importantly, and this is such a hot topic, right, is long-term care. We now know that 70% of Americans will experience a long-term care need. That is when you cannot dress, bathe, transfer, which is get in and out of bed, walk, feed yourself, right? And so I want to make sure that before we start gifting assets away, that there are assets in place so that if that does happen to you, you have the ability to do it. I would hate for folks to pass things down prematurely and then 10, 15 years later become a financial burden to that child because they have spent through money and didn't account for that they may have a long-term care need. Now, that can be circumvented with long-term care insurance. There is an insurance that will cover you in the event that you have a long-term care need. So this is kind of going through, before we start passing money down, we're going to check some boxes off to make sure that we have certain things in place for ourselves so that we don't become a financial burden on others. Now,
very good. Thank you so much.
absolutely.
And it's going to be, for those that may not have heard, attorney Gwendolyn Cook Jones is going to be doing estate planning and wills. And I do know that some of that she probably will talk about, but
Okay.
very good. That's such a good point. Make sure your stuff is in place before you are passing it on. I'll put it that way.
Absolutely. Absolutely. If you don't have life insurance, if you don't have long-term care, I'd much rather you secure those things first before you gift a child $20,000 as a down payment to a home.
Okay. Explain why start with a 529 rather than establishing a Roth.
Yeah, great question. Well, because the laws have changed, right? There was a time when we should kind of tear off what we should do first. But because 529s can be converted to Roths, and because they will most likely have a need for college prior to retirement, we want to start with what is coming at us first. Again, if they don't use that money for college, that's okay. It's no longer wasted. And listen, that's a great thing. Again, I've had clients who've done that, who have invested and put away for that child and have amassed for a 529. And it's been stuck there in limbo because there was a penalty. If you were not using that money for college and you were taking that money out, there's a 10% penalty from the IRS. And so now that waiver has now gone away, that if you're taking money out, there will certainly be a 10% penalty that's not being used for college, but you can convert it to a Roth for that child. So that is wonderful. If that child becomes an entrepreneur or does not follow, the traditional educational path, that is okay. That money is still there and can be given to them without a penalty. So that is why I say 529 before Roth.
Okay. And so when a person is establishing a 529, can you put some of those conditions actually in the writing, that if they choose not to go the traditional route and become an entrepreneur or go into the service or whatever the case may be, can that be put into the 529?
So, great question. So, it really cannot. So, the principle for conversion will always be there. Hey, the child is 17, 18, we're not looking like, we thought it was a gap year. Now it's looking like entrepreneurship. You can then convert it to a Roth. Once it is converted to a Roth, you cannot dictate the withdrawals on that account. You then can't come in and say, hey, I don't want you to take money out of this account, prior to retirement. They can do that. You know what I mean? They can access it if they wanted to. So I do want folks to be aware of that. It is something that will ultimately transition just to their name. But again, that is a wonderful feature, right? Where you just don't have money sitting in limbo, or you're not being subject to a 10% penalty if that child ends up not going to college.
Very good. Let's see. I think we've exhausted all of our written questions. Here, are there certain things that you want to just reiterate or just to
Sure. I'll spend a little time on long-term care insurance because we touched on it, but I want to just dig a little deeper. So, as it relates to long-term care insurance, and I want folks to really understand why this is so important and why people should be researching and learning more about what this is. As I stated earlier, it is expected that 70% of folks will have a long-term care need. And of course, that can happen anytime in your life, right? There are young people who get hit by a bus and they're going to they need assistance and help, right? And so if you have long-term care, it can help to pay for that. But most of the times we see long-term care as it comes into play as an end of life planning tool. Most people are using their long-term care policies at 5 to 7 years before they pass away. And so long-term care, a long-term care need is the number one disruptor of a well-suited and planned financial plan. You can be saving 10 to 15% for retirement. You can be max funding, once you get older. You can have your 6 months of life of savings in your savings account. You can have your investment account that you've had for 20 years. You can have all of these things. But if something happens to you and you have to go into assisted living, go into a nursing home, have a nurse come into your home, or even have a family member come in, right? The cost of that it's outrageous. It can be exorbitant. I mean, it is very common to see assisted living facilities anywhere between $10,000 to $25,000 a month, right? And what I want people to keep in mind is that your monthly expenses have not gone anywhere when this happens, right? You may still have your home, a mortgage, or at least the maintenance. You may have cars, you may have your electric bill isn't going anywhere, your gas bill, your water, all of these things. And sometimes when a long-term care event happens, people are not in the position or nor are they mentally ready to start selling off everything they own to pay for long-term care.
wow.
This is where long-term care insurance can come in. It can fill the gap. It can make you someone who is much more likely to get, into assisted living and that type of care because the facility knows, hey, Danielle has a long-term care policy and we know we're going to get our money every month. I hate to be that callous, but that really is from the business standpoint what these type of places are looking at. So this can be a significant way to enhance and really protect your financial plan. You're doing all these things that we kind of talked about, but we have to add a layer of protection for ourselves. It's great to pass things forward with life insurance. Use that as a tool to create generational wealth, but to protect our wealth and to protect generational wealth, long-term care insurance can be a tool that helps with that.
And when do they take out the long term? If you are retired, it really isn't available. I mean,
Yeah,
it may be available, but the other option that I'm aware of is, doing the estate and making sure when you are well and healthy so that you're protected, so that you don't have to sell off
absolutely.
all of your assets. So, because they look back 5 years, and let's say
Absolutely.
you're doing
Mhm,
well,
mhm, mhm,
that protects you. But so, speak to is it while you are yet working that you should add the uh, long care?
mhm. Yeah, so again, great question. This is all of this is insurance companies that are issuing these policies. And so insurance companies like to see young, healthy people. That is who they feel comfortable insuring, right? Different life insurance companies have different max ages in terms of when they will issue long-term care. So generally speaking, I tell people there's no time like the present. All of this long-term care and just general life insurance, a big factor is based on your age. You will never be younger than you are today, right? So this is a good time to start looking and say, hey, am I insurable? And if so, at what rate? Is it still feasible for me? If you're under 50, make this a priority. If you're in your 20s, this should be a priority. You're never too young, right? In my opinion, to go ahead and start checking things off of your financial checklist. And so, again, I would make it a priority today for everybody who's listening. Tell a friend, tell a family member, hey, have we had a conversation about this? What is our plan as it relates to this?
Very good. Well, you've been extremely helpful, and I just wish we could go on, but we'll definitely have to invite you back. You've been phenomenal. I do want our audience to know, tell them where you're licensed at. I mean, you have several states that
Yeah,
if
I'm licensed in
someone,
several different states. I am based in Washington, D.C. I am licensed pretty much in most states up the East Coast, so Maryland, Virginia, New Jersey, Pennsylvania. I'm licensed in a couple states in the South, and of course, my home state of Michigan. So, if anyone has any questions, feel free to shoot me an email or give me a call, and I'm happy to address any questions or concerns someone may have.
very, very good. I am so appreciative of all of your knowledge, and congratulations to you with such an amazing award or recognition
Yeah.
by Equitable, and to be the second African American woman listed and entering the Hall of Fame.
Yeah.
Well, that says that's impressive. And so my hat's off to you, and thank you for spending this time with us. Just such great, great, great. She mentioned Texas. I'm not sure if you are licensed in Texas, but certainly her contact information, I'm sure she would be willing to have a conversation and answer questions. Her contact information is on the screen. And I want to just say thank you. Any last words? I do want to encourage our audience to share this with others. People need to know and be informed. We lack and we don't know because we sometimes they're just not informed. And when we're informed, we want to do better. We want to do better by teaching our young children, our young people, the value of money, the value of being a good steward, and so forth. And obviously, you have some great values, and I want to thank you for your time, and your husband probably for taking care of your three little ones uh, while you are presenting. Thank you, and hats off to you. Uh, Tell us how you were reached out, and ABC interviewed you to come out to your home to do that. Do you mind sharing that? Is that
Sure.
okay?
Yeah, thank you, Evangelist. And I echo everything that you just said. Please, it is our responsibility. If you are here listening today, please have this conversation with a loved one, a friend, somebody who is not here watching this. Share the content with them, but start off with communicating the subject matter within our own communities. Yeah, I was recognized by our Washington, D.C. morning station during Black
Yeah,
History Month to highlight Black financial professionals and really the work that we're doing in the community and sharing tools like I shared today about generational wealth. How can we build it? How can we create it? And how can we pass it forward?
that's awesome. Just wonderful. We're going to end with, well, everyone, others are saying thank you online. So I want you to know that everyone's appreciative of your time and effort. And I want to remind everyone that are on tonight to come back and be with us if you can, or listen to the replay on Thursday. We're back at 7 o'clock. And I'm just excited to that these great women, what a great month to have women that are skilled in many different areas and sharing their knowledge and wisdom and expertise in many different areas. So Danielle, you were phenomenal tonight, just as as I expected, and even beyond what I expected, because you're just doing great things, and God bless you in your efforts. And we're just going to have a word of prayer. Father, we thank you for Danielle and how you have blessed her, and we just give you glory and honor, and we ask that you continue to use her to your own will and to your own glory, that she will continue to be a blessing to the people all over wherever you should have her go. And we thank you for those listeners, and we pray, God, that you would just continue to help us not only to be hearers but be doers of what we have received on tonight. We ask these blessings in Jesus' name. Amen. Well, thank you. We're going to end our broadcast, and I'm going to ask you, Danielle, just to stay with us, and we just appreciate what we've received on tonight.